Risk financing, business and corporate risk financing. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses risk financing. In this video, you will understand the meaning of risk, the cost of risk, components of the cost of risk, ways of controlling risks, risk financing techniques, risk retention groups, self-insurance, insurance, traditional insurance contracts, loss-sensitive insurance contracts, hedging, other contractual risk transfers, diversification, risk financing through investment in information technology, derivatives, and the difference between derivatives and insurance. Now, let us start. What is a risk? Risk is the uncertainty of financial loss. A risk is anything that may affect the achievement of an organization's objectives. It is the uncertainty that surrounds future events and outcomes. It is the expression of the likelihood and impact of an event with the potential to influence the achievement of an organization's objectives. Risk, uncertainty, may affect the achievement of objectives. Risks may be harmful or beneficial to a business. From a business perspective, there are good and bad risks. Good risks connote business opportunities, and bad risks connote threats or adverse events. Hence, every opportunity that creates value may be considered a good risk. Bad risks include ignoring regulations or failing to implement effective policies and procedures. Risks, good or bad, should be well managed. The implication is that management of risks entails costs that may be financial or non-financial. It is, therefore, good to understand the cost of risk before discussing risk financing techniques. Now, let us examine the cost of risk. The cost of risk dash. Cost of risk expenses consists of the cost incurred in financing risks or losses if they materialize or occurred. Risks can be retained internally or transferred to another company, for example, transferred insurance. Hence, the cost of risks can also be described as a cost of risk expenses or cost of risk financing. Cost of risk expenses, whether retained or transferred losses, include 1. Administrative expenses. This includes internal administration cost, purchased services, and insurance premium taxes paid. 2. Risk control expenses. This includes costs incurred to prevent losses or reduce the severity of losses. 3. Retained losses. These are losses retained by generation within or outside the organization to pay for the losses. 4. Transfer costs consist of the cost that an organization pays outside the firm to transfer its risk of loss to insurance and non-insurance firms, for example, the insurance premium paid to insurers or service fee paid to consultants or other professionals. Understanding the cost of risk dash. A good understanding of the cost of risk is essential to ensure effective loss control and mitigation. This is necessary because 1. Risk management decisions must be made before losses occur. 2. The magnitude of actual losses in each period can be determined after knowing the fact, that is, frequency and severity of risks. 3. Before losses occur, the cost of loss reflects the prediction or expected value of losses in the future. 4. The cost of losses can be determined ex post, after the fact, and estimated ex ante, before the fact. In essence, the cost of losses can be determined before or after knowing the frequency and severity of accidents. Components of the cost of risk dash. The cost of risk has 5 main components: 1. Expected cost of losses, 2. Cost of loss control, 3. Cost of loss financing, 4. Cost of internal risk reduction, and 5. Cost of residual uncertainty. 1. Expected cost of losses. The expected cost of losses includes the expected cost of both direct and indirect losses. Hence, the expected cost of losses equals direct losses plus indirect losses. Direct losses include the cost of repairing or replacing damaged assets and the cost of paying compensation claims to injured workers. Indirect losses include reductions in net profits due to direct losses, loss of profits for previous investments, legal costs, and other costs associated with revamping or liquidating a business. 2. Cost of loss control. The cost of loss control includes risk financing costs associated with 1. Increased precaution and 2. Reduced activity. The cost of loss control reflects the cost of increased precautions and limits on risk activity designed to reduce the frequency and severity of accidents. For instance, the cost of loss control of an electronic company would include the cost of testing its product for safety before the production and any lost profit from limiting distribution of the product to reduce exposure to lawsuits and third-party claims. 3. Cost of loss financing. The cost of loss financing includes 1. Retention and self-insurance, 2. Insurance, 3. Hedging, and 4. Other risk transfer. Insurance, hedging, other contractual risk transfers, and certain types of loss control can reduce the uncertainty associated with losses. These risk management methods can make the cost of losses more predictable. The cost of self-insurance includes the cost of maintaining in-house reserve funds to pay for losses. The cost of loss financing through insurance reflects the loading in insurance premiums for the insurer's administrative expenses and required expected profit. Hedging includes the transaction costs involved in arranging, negotiating, and enforcing hedging arrangements. Other contractual risk transfers may include engaging an expert or professional to undertake a task or offer services for a fee. 4. Cost of internal risk reduction. The cost of internal risk reduction includes 1. Diversification, and 2. Investments in information. The cost of internal risk reduction includes transaction costs associated with achieving diversification and cost associated with managing a diversified set of activities. The cost of internal risk reduction also includes the costs of obtaining and analyzing data and other types of information to obtain more accurate cost forecasts. 5. Cost of residual uncertainty. Not all risks can be eliminated. Hence, some risks will surely exist within an organization. Such risk is the source of residual uncertainty. Examples of residual uncertainty include 1. Shareholders' interest, and 2. Stakeholders' influence. Uncertainty about the magnitude of losses will often be eliminated through loss control, insurance, hedging, other contractual risk transfers, and internal risk reduction. The cost of uncertainty, that is, left over, when the firm has selected and implemented loss control, loss financing, and internal risk reduction is called the cost of residual uncertainty. The cost of residual uncertainty arises because uncertainty is generally costly to risk-averse individuals and investors. Ways of controlling risks. Adequate mitigation strategies/controls can reduce adverse risks and increase opportunities, but not all risks can be eliminated. Such risk is known as residual risk. Residual risk is the level of risk after evaluating the effectiveness of controls. Risk control should be based on residual risk levels. There are 5 primary ways of controlling risks, consisting of 1. Risk avoidance. 2. Risk retention, means risk acceptance. 3. Risk mitigation means risk reduction or minimization. 4. Risk transfer, means transfer of risk through traditional insurance contracts and other third parties. 5. Risk sharing means sharing risks through loss-sensitive insurance contracts. These 5 ways of controlling risk will be discussed later in this video. You should ensure that you watch the video to the end to have a good understanding of how to finance risks. A firm can control its loss, that is, loss control, through 1. Increased precaution, and 2. Reduced activity. Likewise, a firm can finance its loss, that is, loss financing, through 1. Retention and self-insurance, 2. Insurance, 3. Hedging, 4. derivatives and 5. Other risk transfers. Let us now proceed to discuss risk financing. Risk financing dash. Risk financing is concerned with the provision or generation of funds to pay for losses or offset the financial or economic effect of unexpected losses experienced by a firm. Risk financing involves the retention of risks, combined with adopting an explicit financing strategy to ensure that adequate funds are available to meet financial needs should a disaster occur. Such financing can be established internally by accumulating funds set aside for future use or obtained externally through pre-arranged credit facilities. Objectives of risk financing. Goals of risk financing include 1. To ensure losses are paid or finance, 2. Maintaining an appropriate level of liquidity, 3. Maintaining uncertainty of loss outcomes, 4. Managing the cost of risk, and 5. Complying with legal requirements, for example, compulsory insurance. Sources of risk financing include firms' internal funding, the banking sector, capital markets, and international lending institutions. Risk financing is closely associated with risk management techniques. Risk financing techniques. Generally, risk financing techniques can be classified into two broad categories: risk transfer and risk retention. Risk transfer involves transferring risk through insurance and non-insurance techniques to shift the financial consequences of loss to another party. Insurance and non-insurance risk financing techniques will be discussed later in this video. Risk retention is a risk financing technique whereby losses are retained by generating funds within and outside the organization to pay for losses. Business risks can be managed and reduced internally. This is known as internal risk reduction. Business risks can be reduced internally through 1. Diversification, and 2. Investments in the information. Major ways of financing business risks include 1. Risk retention. 2. Self-insurance. 3. Insurance, including traditional and loss-sensitive insurance contracts. 4. Hedging. 5. Diversification. 6. Investment in information. 7. Derivatives, and 8. Other contractual risk transfers. Risk retention. Risk retention is a risk management technique whereby a company decides to absorb and accept, partly or wholly, potential loss rather than transfer the risk to an insurer or other party. The company consciously retained the consequences of risk rather than transferred the risk to an insurance company or other party. Risk retention approach is the extreme opposite of the risk transfer approach in that it upholds the principle of taking responsibility for one's action. Risk retention technique is the intentional decision of an organization to handle and manage specific risks internally rather than transferring them to insurance or any other third party. Consequently, the organization's risk is self-financed and managed. Risk retention is a form of self-insurance. Organizations may decide to retain risk when a cost analysis review shows that it is cost-effective to handle the risk internally instead of fully or partially insuring it with an insurance company. Companies may also decide to retain risks when the premium or cost of transferring them is substantially high. However, risk retention is appropriate for high-frequency, low-severity risks where potential losses are relatively small. Risk retention is one of the ways businesses can finance their losses. Experience has shown that organizations choose to transfer high risks and retain loss risks. Retention is a technique for managing risk where a firm retains part of all the financial consequences of a given risk. Retention can be either active, that is, planned and conscious retention, or passive, that is, unplanned retention. Active risk retention. Active risk retention means that an individual or organization is consciously aware of the risk and deliberately retains all or part of it. Active retention entails prior awareness of a risk, with a conscious provision to finance losses arising therefrom. Active risk retention may be used for two primary reasons. First, risk retention can save money. Insurance may not be purchased at all, or it may be purchased with voluntary excesses. Either way, there is often a substantial saving in insurance costs. Second, the risk may be retained voluntarily because commercial insurance is unavailable or can only be obtained by paying prohibitive or huge premiums. Passive risk retention. Risk can also be retained passively. Passive retention entails a lack of awareness about risk, thereby accepting the risk unknowingly or unconsciously. Certain risks may be retained unknowingly due to ignorance, indifference, or laziness. Passive risk retention may be harmful to an organization if the retained risk can adversely impact its activity and continual existence. Funding for retained risks. Retained risks, retention, may be funded within or outside a firm. There are two ways of funding retained risks: 1. Funded retentions, and 2. Unfunded retentions. There are three general methods of paying for retained losses. 1. Pre-loss funding. This means that fund is set aside to finance risk before the occurrence of a loss. Pre-loss funding usually involves establishing a funded account in advance to finance losses arising from consciously or active retained risks. 2. Current loss funding. This means that fund is not set aside in advance to finance retained risks, but the loss is financed from the company's working capital or miscellaneous fund when the need arises. Current loss funding implies paying for losses out of current earnings or working capital. 3. Post-loss funding. This means that fund is not set aside before the loss, but an arrangement is made subsequently to raise funds to finance the loss. Post-loss funding entails borrowing funds to pay for a loss. Generally, retention entails a fundamental trade-off between 1. The benefits to the firm from increased retention in the form of possible reductions in expected cash outflows for insurance, and 2. The expected costs to the firm that arise from more significant risk. Retention should only be used for high-frequency and low-severity risks where potential losses are relatively small. There are two forms of risk retention: internal and external risk retention. 1. Internal risk retention is an in-house, within an organization, technique whereby a firm consciously accepts to bear financial consequences of risk from its operating fund or miscellaneous reserve. 2. External risk retention is a technique for managing risk where a firm transfers the financial consequences of risk to an insurance company or other third party. An organization can also transfer its risks to risk retention groups. Risk retention group. Risk retention groups allow similar businesses to form groups to provide self-insurance. Commonly found in the United States of America, USA, the United Kingdom, UK, and some European Union, EU, countries. A risk retention group is a corporation or other limited liability association functioning as a captive insurance company and organized for the primary purpose of assuming and spreading the liability risk exposures of its group members and member owners. Risk retention groups started emerging in the mid-1980s due to the passing of the Federal Liability Risk Retention Act of 1986 in the USA. The 1986 Act requires that all owners of risk retention groups must be insured with the risk retention group and engaged in similar businesses or activities. The Act requires that each group should be licensed in at least one state in the USA to accept liability risks in all states. Advantages of risk retention groups. 1. Profits are retained by owners who are the policyholders. 2. Avoidance of multiple state filing and licensing requirements. 3. Stability of cover, ensures accuracy and reduced premium. 4. Broader scope of cover based on members' exposures. 5. Project insured's interest, ensures more receptive to implementing loss control measures. 6. Reinsurer relationships can be established directly with reinsurers, leading to improved reinsurance premiums and more excellent stability. 7. Members can share information about their businesses and areas of interest. 8. Services of professional underwriters and claims managers can be engaged to manage the group risks and claims. Disadvantages of risk retention groups. 1. Risks are limited to liability insurance. 2. Not permitted to write outside or non-member businesses. 3. Poor results impact all members because a member's bad claim experience can lead to all members paying extra premiums. 4. Difficulty in re-entry into the market. If the group fails, re-entering the commercial insurance market may be more costly with less broad coverage. 5. Hoarding of information by members. Members may not be willing to share information about their businesses with others. Methods of funding loss arising from internal retained risks. Businesses can finance internally retained risks, that is, internal risk retention, in 3 primary ways. 1. Using internal funds, losses may be financed from operations cash and dedicated assets. Since cash flow may not be sufficient, a funded account can be established in advance to finance losses arising from internally retained risks. 2. Establish lines of credit with pre-commitments from lenders to borrow funds needed to pay losses. 3. Raise external funds after a loss by borrowing money or issuing new equity securities. Self-insurance. Self-insurance is a risk management method whereby an individual or an organization sets aside a sum of money to finance and mitigate an unexpected loss. By principle, one can self-insure against any type of damage, such as flood or fire. Most people choose to buy insurance against potentially significant and unusual losses. The theory is that since the insurance company aims at making a profit by paying premiums above the expected losses, a self-insured person should be able to save money by setting aside the money in emergency funds, which would have been paid as insurance premiums. Self-insuring against certain risks may be more affordable than buying third-party insurance. The more gradual and minor the failure, the greater the likelihood of a person or firm opting to self-insure themselves. Self-insurance is a risk management technique that organizations can adopt. With retention, a firm retains the obligation to pay for part or all its losses. When retention is supported with a formal plan to fund losses for medium to large businesses, then the retention is often called self-insurance. Self-insurance is a conscious or planned retention by which the firm retains fully or part of loss exposures. For example, a large corporation may self-insure or fund part of all its risk, such as paying employees group health insurance benefits. The associated cost of self-insurance includes 1. The cost of maintaining in-house reserve funds to pay losses. 2. Taxes on income from investing these funds, and 3. Possible opportunity cost that can occur if maintaining reserve funds reduces the ability of the company to undertake profitable investment opportunities. Characteristics of insurable risks. Not all risks can be insured by insurance companies, that is, insurers. Risks that can be transferred to or insured with insurers are known as insurable risks, while risks that cannot be transferred to or insured by insurers are known as uninsurable risks. Insurable risks must possess the features or characteristics of insurable risks. Characteristics of insurable risks include 1. Insurable risks tend to be pure risks. 2. There must be a large number of similar risks, that is, homogeneous exposures. 3. The expected loss must be financially calculable or has a pecuniary value. 4. It should be possible to determine the loss in time and cause. 5. The insured must have an insurable interest in the event or risk insured. 6. The loss should be fortuitous or accidental. 7. The insurance must not be against public policy or the law. 8. The premium paid by the insured must be reasonable. How does insurance operate? Insurance operates based on 4 key ingredients. 1. Risk transfer, this extends to reinsurance and retrocession contracts. 2. Creation of common pools based on the laws of large numbers. 3. Payment of equitable premiums by the insureds. 4. Avoidance of adverse selection against insurers. Risk transfer. Insurance is a risk transfer mechanism. Insurance and reinsurance and contracts are subject to risk transfer practices. The primary insurance contract is between the insured and the insurer. Under the primary insurance contract, the insurer must reinsure, that is, transfer part of the risk accepted under the primary insurance contract, with another insurer or reinsurer. This contract is known as reinsurance, and the contract is between the reinsured, the primary insurer under the insurance contract, and the reinsurer, the reinsurance company. Furthermore, the reinsurance company must also reinsure, transfer part of the risk undertaken under the reinsurance contract, with another insurer or reinsurance company. This contract is known as retrocession. Under retrocession, the insured, who is the reinsurer under the reinsurance contract, is known as retrocedent and the insurer is known as the retrocessionaire. The retrocessionaire is also expected to reinsure or transfer part of the risks underwritten to another insurance or reinsurance company. This shows that risk transfer is a core aspect of insurance practice. Common pool dash. Common pool is a term used to describe the accumulated premium paid by insureds to an insurance company. Premiums are collected from insureds, pooled together, and used by the insurer to pay losses in 1 year. The common pool is based on the laws of large numbers. Common pools facilitate sharing losses among all policyholders rather than being borne solely by the unfortunate insureds who experience losses. Payment of equitable premium dash. All insureds and policyholders must pay equitable or commensurate premiums to the insurer. Each insured's premium paid to the insurer must be commensurate with the risk brought to the common pool. For instance, an insured who introduces significant risk should pay a higher premium than those who introduced average risks to the common pool or the pool of risks. Adverse selection against insurers. Adverse selection is the tendency of persons with a higher than average chance of loss to seek insurance at standard, average, rates, which results in higher than expected loss levels if not controlled by underwriting. How do insurers cope with adverse selection? Methods of dealing with adverse selection by insurers include, 1. Seeking information disclosure, 2. Selecting a niche market or class of insurance. 3. Prudent underwriting, and 4. Effective use of insurance policy conditions. Legal principles of insurance. The nature of the legal principles of insurance varies from country to country. Meanwhile, there are 6 principles of insurance, including utmost good faith, insurable interest, indemnity, subrogation, contribution, and proximate cause. Now, let us briefly discuss these principles of insurance. Utmost good faith. Both parties to the insurance contract must disclose facts that are material to the risk, even if specific questions are not asked. Facts that are material to risk are referred to as material facts. According to Section 18(2) of the Marine Insurance Act 1906, a material fact is every circumstance which would influence the judgment of a prudent and reasonable underwriter in fixing a premium or determining whether to accept the risk. Examples of facts that must be disclosed by proposers, that is, material facts, include 1. Facts that suggest the risk is greater than the norm. 2. Facts that would increase the possibility of loss. 3. Previous claims or losses. 4. The existence of other policies of the proposer. 5. Fact which reduces an insurer's subrogation rights, and 6. Facts relating to, and descriptions of, the subject matter of the insurance. Modification of duty of disclosure on the part of insurers. Both parties, that is, the insured and the insurer, to an insurance contract must disclose material information or material facts to each other. This is known as the duty of disclosure. The duty of disclosure of the insured is relatively straightforward. However, some people thought that the onus of the duty of disclosure lies only on the insureds, not on insurers. This is incorrect, as the duty of disclosure lies on both the insured and the insurer are required to disclose material facts and act in good faith in an insurance contract. In most parts of the world, the duty of disclosure has been modified. Generally, the modification of duty of disclosure emphasized that a questionnaire or proposal form for insurance should be prepared to elicit material information required by insurers to determine whether to accept the proposed risk. The proposal form must be printed in easily readable letters. Immaterial facts are facts that need not be disclosed by the parties to an insurance contract. Examples of facts that the insurer do not need to disclose, that is, immaterial facts, include 1. Facts that improves the risk. 2. Facts of common knowledge and facts of law. 3. Facts that reduces the level of risk. 4. Facts which the insurer can easily be ascertained from the disclosed information and the report of survey and physical inspection. 5. Facts that are unknown to the insured, and 6. Propose as spent convictions. Insurable interest. Insurable constitutes the legal right to insure arising from a financial relationship recognized at law between the insured and the subject matter of insurance, which is the item insured, for example, buildings and vessels. This means that anyone who insures must have a legal and financial interest in the subject matter of insurance. Insurable interest was initially introduced to distinguish insurance from gambling. Depending on the type of insurance, an insurable interest must exist either at the inception or beginning of the contract or at the time of loss. When does insurable interest arises? 1. Life insurance. For life insurance, the insured must have an insurable interest at the inception or beginning of the insurance contract. 2. Marine insurance. The insured does not need to have an insurable interest at the inception of marine insurance, but must have an insurable interest at the time of loss. 3. Other insurances. Other than life and marine insurances, the insured must have an insurable interest at both the inception of the contract and at the time of loss. Indemnity. Insurance policies should only pay to the extent of financial loss which has occurred, that is, the insured cannot make a profit out of an insurance claim at the expense of the insurer. Life insurance, accident and sickness insurances are not indemnity contracts, but they are benefit contracts. There are 4 ways of indemnification: payment of cash, repair, replacement, and reinstatement. However, the method used is at the insurance company's discretion, and there will generally be limits on indemnity, that is, the maximum liability. Subrogation. Subrogation is the right of an insurer, having indemnified the insured, to stand in the insured's place to avail himself of all its rights and remedies, whether already enforced or not. However, the insurer right of subrogation is limited to the amount of claims settled. Subrogation and contribution principles are corollaries of indemnity. The 2 principles, that is, subrogation and contribution, apply to indemnity contracts, but they are not applicable to benefit contracts. Contribution. Contribution is the right of an insurer to call on other insurers who are liable, but not necessarily equally liable, to share the cost of an indemnity payment. The principle of contribution ensures that all insurance policies covering a risk pay a rateable proportion of every loss. If an individual or firm has more than one insurance policy covering a loss, the total claim cannot be collected from each of them. Instead, all the policies will pay a rateable proportion of the total claim. Proximate cause. Proximate cause has been defined in the case of Pawsey v. Scottish Union and National 1907 as the active, efficient cause that sets in motion a train of events which brings about a result without the intervention of any force started and working actively from a new and independent source. What is a peril? Peril is a loss-causing event, such as fire, theft, flood, and explosion. The loss must be caused by an event or perils that are covered under the policy. 3 types of perils may cause a loss in an insurance contract: insured peril, excluded peril, and uninsured peril. 1. Insured peril is an event or peril expressly stated as covered and insured on the insurance policy. 2. Excluded peril is an event expressly excluded or not covered on the insurance policy. 3. Uninsured peril is an event not expressly included in the insurance policy, but an insurer can pay for a loss caused by uninsured perils provided the event is an action aimed at reducing the loss. Each occurring in isolation generally causes no problem. However, combinations of perils may be extremely complex and problematic. For instance, insurers will pay for losses caused by insured perils and uninsured perils geared towards minimizing a loss, while insurers are not obliged to pay for losses caused by accepted perils and uninsured peril, which aggravate a loss. The proximate cause can become very complicated when there is a chain of events leading to a loss. The court should resolve controversial cases. Businesses can purchase two major kinds of insurance policies to manage their risks: 1. Traditional insurance contracts, and 2. Loss-sensitive insurance contracts. Now, let us discuss these two kinds of insurances contracts. Traditional insurance contract. This is an insurance contract whose premium depends on the value at risk and feature of the subject matter insured, that is, the item or risk insured, at the inception of the insurance contracts. Traditional insurance contracts include fire insurance, theft insurance, money insurance, credit insurance, business interruption insurance, contractors' all-risk insurance, goods in transit insurance, engineering insurance, motor insurance, marine insurance, aviation insurance, public liability insurance, product liability insurance, professional indemnity insurance, employers' liability insurance, directors' and officers' liability, contingency insurance, life insurance, sickness and accident insurance. Classes of traditional insurance. Policies. Fire insurance. Standard fire policy was traditionally designed to cover a building, plant machinery and stock against fire, lightning, and certain types of explosions. Additional perils are now added to fire insurance in response to customer needs. Fire and special perils insurance can be purchased by businesses to cover their fire risk exposure. Theft insurance. Theft insurance covers theft accomplished with forcible entry and exit from premises. Money insurance covers physical loss or damage to cash and negotiable instruments, for example, checks and money orders, on premises and in transit, includes theft but excluding theft by employees. Credit insurance covers a firm against non-payment for goods and services supplied or sold on credit. Business interruption insurance, also known as loss of profit or consequential losses, indemnifies the insured against business disruption arising from an insured peril. Cover includes loss of gross profit, wages, additional costs of working, and the cover is usually for 12, 24 and 36 months. Contractors' all-risk insurance, usually issued on an all-risks basis to provide indemnity against any cause except war and civil commotion, consequential loss, cessation of work, defective design, defective material or workmanship, breakdown of a plant, and lack of maintenance. Goods in transit insurance covers the owner or the carrier of goods for damage or loss incurred during inland transit. Attention is given to the quality of the carrier. Engineering insurance provides indemnity to the insured for loss or damage to plant and machinery. Insurers offer an inspection service with or without insurance coverage. In some countries, regular plant inspection is statutory, and the insurer may be authorized to carry these out. Accident insurance, individual or group, provides compensation for accidental injury or sickness to a named person or persons. Motor insurance, private and commercial, covers liability regarding road accidents towards third parties and damage to the vehicle itself. Motor insurance cover ranges from comprehensive to ACT covers. Motor trade insurance policy. A motor trade policy is a specialist motor insurance package policy for garages. It also covers the building, showroom, and vehicles. May also cover vehicles under the care of the garage's custody and control. Marine insurance provides cover against the perils of the sea, for example, sinking, heavy weather damage, fire, collision, piracy. Cover may include the hull, the cargo, or the freight, payment for the carriage of cargo. There are 5 forms of marine insurance including voyage, mixed, construction, floating and open cover. Aviation insurance covers hull, passenger liability and third-party liability, usually on all risks basis. The insurance can be purchased by airlines, individuals, and flying clubs. Liability insurances: firms may become liable for bodily injury or damage to property caused by their acts or omissions. The liability may arise out of negligence, statute, or contract. The potential for claims to arise often relates to local culture, custom or predisposition of the legal system to support such actions. There are several liability insurances, including employers, public, products, professional indemnity, directors, and officers. Public liability insurance covers the liability of a business to the public because of its operation, for example, pollution, injury to a visitor, damage to third-party goods in the custody of the insured. The policy will specify limits of liability offered by the insurer, and a higher limit can be granted subject to request. Product liability insurance covers liability arising out of goods sold, supplied, repaired, or serviced by the insured. Claims for damages usually fall into four categories: defective design, defective manufacture, defective warnings, and negligent surveillance or lack of safety. Professional indemnity insurance covers negligent acts carried out, and advice is given as part of a professional service such as lawyers, accountants, and brokers. Employers' liability insurance covers employers' liability to employees for personal injury arising out of their employment activities. This is compulsory in many countries, and sometimes cover goes beyond just negligence and is called workers' or workman compensation. Directors and officers, D&O, liability insurance, covers the personal liability of directors for how they run their companies. The policy is essential because of the increasing corporate scandals in the last decade. Directors of all companies are now held, at an unprecedented level, to be personally responsible for any actions and decisions they make on behalf of the company, putting their assets at risk if those decisions are tested in court. Contingency insurance: this insurance covers miscellaneous risks that are not primary insurance classes, for example, events or contracts cancellation. Having explained traditional insurance policies, we now examine loss-sensitive insurance, which is the second kind of insurance contract. Loss-sensitive insurance contracts. Loss-sensitive insurance contract is an insurance policy whose premiums depend on the loss experienced. Loss-sensitive insurance contract is an insurance rating for which the final premium is dependent on the actual losses during the period the plan is in effect. This risk financing technique places upper limits on the insured's costs if its losses are high and require a minimum premium if it experiences low losses or is loss-free. Hence, the risk financing costs of loss-sensitive insurance contracts tend to vary based on actual loss experience. Loss-sensitive insurance provides an incentive for firms to emphasize safety and loss control activities. With a loss-sensitive structure, a firm pays a lower premium for partial coverage of a loss above its deductible. The organization can further reduce the retained costs by improving safety and claims handling procedures. Advantages of loss-sensitive insurance. Advantages of loss-sensitive insurance include lower premiums, savings through loss control and claims handling, improved cash flow and investment income, price stability, and lower cost of risk. Examples of loss-sensitive plans include deductible plans, retrospective rating plans, dividend plans, and retention plans. Loss financing through hedging. Hedging is a way of financing risk and losses. Hedging is the purchase or sale of one asset to offset the risks associated with another asset. Hedging is a transfer of risk without buying insurance policies. Generally, hedging is contracts that can be used to hedge, offset losses, risks. The asset held to offset the risk is often a contract, such as an option or futures contract. Hedging is a transaction that reduces the risk of an investment. Commodities, such as energy, metal or agricultural, foreign exchange rates or currencies, and interest rates are frequently hedged. The risk transfer is the exposure to loss from decline or increases in an asset's market price. The asset concerned is the hedging party holds for an extended period as a regular part of doing business. Practical examples of hedging. Hedging is a risk financing measure that is well suited to firms' risks created by price changes. To ensure a thorough understanding of hedging, let us consider two practical examples of hedging. Practical example 1 of hedging: suppose a manufacturer knows it would require a substantial quantity of oil to support its manufacturing activities and is concerned about the volatility in oil prices. The manufacturer can hedge against changes in oil prices by entering a contract to buy the oil at a specific price and time in the future. This type of hedging of speculating business risks allows an organization to protect itself against possible price level losses by sacrificing possible price level gains. Practical example 2 of hedging: suppose a plantain farmer is exposed to loss if the market price of plantain drops significantly between when he plants the crop and when he sells the harvest. However, the farmer is expected to lose if the market price decreases, and plantain consumers such as plantain chips producers may profit from such a price decrease. If the market price were to rise, the farmer would profit, but plantain chips producer would be exposed to a loss. To manage this market price risk, the farmer could enter a plantain hedge with the plantain chips producer during the plantain growing season, locking in a future sales price via a future contract before bringing the plantains to market. Changes in market prices, increase or decrease, would no longer affect the farmer's anticipated revenue on a per unit basis, just as they would no longer affect the producer because the price has already been agreed upon earlier. Both producer and farmer are insulated from gains or losses associated with market price changes. As you can see, hedging is a risk management strategy suitable for limiting or offsetting the probability of loss from fluctuations in prices, commodities, currencies, or securities. Commodities, such as energy, metal or agricultural, foreign exchange rates or currencies, and interest rates are frequently hedged. Any price or other financial value that is uncertain in the future can be objectively measured, such as stock market index, typical stock price, commodity price, or consumer or industrial price index can be the basis for a hedge. Those prices or financial values are called underlying assets. Hedging techniques generally involve the use of complicated financial instruments known as derivatives. Financial derivatives, such as forwards, futures, options, and swaps, can be used by firms to manage risks, particularly price risk. Derivatives enable firms to hedge against systemic and non-systemic risks. The risks most often hedged with derivatives are foreign exchange rates, interest rates, commodity prices, and equity prices. Loss financing through other contractual risk transfers. Other contractual risk transfers allow firms to transfer risk to another party. For example, firms can engage independent contracts to perform some tasks. Outside the insurance context, contractual liability has a broad meaning or agreement that a court may enforce. Factors affecting contractual risk transfer include control of the risk, knowledge of the risk, statutory or common law limitations on risk transfer, custom and practice, and bargaining position. Some factors influence contractual risk transfer. Factors influencing contractual risk transfer - Factors affecting contractual risk transfer include 1. Control of the risk: who is in the best position to control the risk? For example, a construction contractor, as opposed to an owner, might better control job site accidents due to contractual management requirements. 2. Knowledge of the risk: does one party's knowledge of risk make them more logical to assume risk? For example, a demolition contractor using explosives to demo a building might be the logical choice to assume the risk of injuries and damages due to their unique expertise. 3. Statutory or common law limitations on risk transfer. This may limit the risk that can be transferred via contract. Example, when a statute or common law prohibits one party from assuming another party's sole negligence. 4. Custom and practice, generally accepted modes, owner to the general contractor or general contractor to subcontractor. 5. Bargaining position: the more extensive the entity, the more likely to transfer risk to the smaller entity. The more competitive the marketplace, the more risk a company is likely to accept in negotiations. Those entities with a reputation for a firm bargaining position may obtain a preferred risk position because of their reputation. Risk financing through diversification. Diversification is another way of financing a loss or risk. Investors can eliminate diversifiable risks by holding a diversified portfolio. In contrast, non-diversifiable risk cannot be eliminated by investors through diversification. Diversifiable risk does not affect the opportunity cost of capital. This is because diversifiable risk and associated costs can be eliminated through diversification. Non-diversifiable risk increases the opportunity cost of capital. This is because diversification cannot eliminate non-diversifiable risk, hence, the fund must be set aside to manage the associated cost. Diversification may be two primary forms: 1, diversification of operations, and 2, internal diversification. Firms can diversify their operations by reducing their demand for insurance and hedging using derivatives. Firms can diversify their operations by acquiring or investing in other firms or by adopting new projects whose cash flows are not perfectly correlated with their other cash flows. Besides insurance and hedging arrangements, diversification generally often allows firms to reduce the variability of cash flows. Notwithstanding the benefits of risk reduction, modern acquisitions are usually not undertaking solely for diversification. This suggests that not all internal diversification increases the firm's value. The critical issue is whether internal diversification increases the firm value or is harmful to the firm, considering 1, its shareholders' ability to diversify their portfolios, and 2, the costs of diversification at the firm's level. Synergy exists when the combination of the parts has a greater value than the sum of the individual values, thereby reducing the firm's risks. Risk financing through investment in information technology. Investment in information is another way of financing a loss or risk. Firms can invest in information to obtain superior forecasts of expected losses. Investment in information can produce more accurate estimates and forecasts of future cash flows to reduce the variability of cash flows around the predicted value. Many firms specialize in providing information and forecasts to other firms and parties. Derivatives. Derivatives are financial products that derive their value from the price of an underlying asset. They usually exist as a contract between two parties, traded over the counter or on a stock exchange. Many underlying assets can be traded using derivatives, including forex, shares, indices, bonds, and commodities. No physical assets are being traded when derivative positions are opened. Derivatives are suitable for professional and private investors who wish to hedge an open position or gain exposure to assets and markets without necessarily holding the underlying assets. Speculators may also trade derivatives with the sole purpose of making profits on short-term price movements. Examples of derivatives. Traders often use derivatives as a device to speculate on the future price movements of an asset, whether that be up or down, without having to buy the asset itself. There is a wide range of derivative products that can be used to manage risks. A popular derivative product is a contract for difference, CFD. When a person trades CFD, he has entered a contract to exchange the difference in the price of an asset between the opening and closing positions. The person will not take ownership of any assets when trading CFDs. Instead, he is speculating on the underlying price. Other examples of derivatives include options, forward contracts, and futures contracts. Advantages of derivatives. Trading derivatives can be used to hedge and minimize losses. This is because derivative products offer more significant flexibility compared to trading the underlying asset directly. With traditional investing, a person opens a long position by buying an asset hoping that it rises in value. With derivatives, the person can also speculate markets that are falling in price by opening a short position. Some derivative products are traded on margin, which means that a person only needs to put down a fraction of the value of a position to receive total market exposure. Any profit to the position is calculated using the trade's full value. This means that returns on successful trades can be enhanced, and losses can also be extensive. Hence, it is essential to consider the total value and downside potential of the trade. Disadvantages of derivatives. Derivatives are sometimes criticized for adding to market volatility. In the past, speculators have been accused of greed during times of increasing fuel and food prices and causing drastic swings in the markets. Price movements fueled by speculation can lead to speculative bubbles, which push the intrinsic value of an asset above its regular market price. When speculative bubbles burst, the effects are often devastating on the markets and even on countries' economies around the world. This happened in 2008 when the American housing bubble burst. Benefits of using derivatives. Generally, benefits of using derivatives include: 1. Leverage provides a capital-efficient way to gain exposure to underlying assets. This creates greater volatility which amplifies gains and losses. 2. Derivatives allow investors to take advantage of price movements in the underlying assets. 3. They are typically liquid and easily traded. 4. They serve as a tool for portfolio diversification. 5. The added benefit of short selling affords users the opportunities to benefit from downward price movements. The difference between derivatives contracts and insurance contracts. Characteristics of derivatives contracts include: 1. Derivatives contracts focus on hedging market price risk. 2. Derivatives contracts involve many firms potentially in a specific contract. 3. Basis risk, that is, uncertainty regarding the effectiveness of a hedge, in derivatives contracts is high. 4. Contracting cost of derivatives contracts is low due to moral hazard, adverse selection, and bounding contractual performance. 5. Derivatives contracts liquidity is low due to many firms potentially interested in a particular contract and contracting costs. Characteristics of insurance contracts. 1. Insurance contracts focus on firm-specific risk. 2. Insurance contracts involve one or more insurance firms, insurers or co-insurers, potentially in a specific contract. 3. Basis risk, that is, uncertainty regarding the effectiveness of a hedge, in insurance contracts is low. 4. Contracting cost is high depending on the moral hazard, adverse selection, and bounding contractual performance. 5. Insurance contracts liquidity is low due to firms potentially interested in a particular contract and contracting costs. Conclusion. Risk financing has been discussed in this video. Risk is the uncertainty of financial loss. A risk is anything that may affect the achievement of an organization's objectives. Risks can be retained internally or transferred to another company, for example transferred in insurance. Risk financing is concerned with providing or generating funds to pay for losses or offset the economic effect of unexpected losses experienced by a firm. Risk financing involves the retention of risks, combined with adopting an explicit financing strategy to ensure that adequate funds are available to meet financial needs should a disaster occur. Significant ways of financing business risks include risk retention, self-insurance, insurance, including traditional and loss-sensitive insurance contracts, hedging, diversification, investment in information, derivatives, and other contractual risk transfers. I hope the video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.